So I would agree that this year is very different than 2020. However, when you look at things like the percentage of stocks above their 50-day moving averages, it is now down to 2%. That certainly was present back in 2016 and 2018. We have finally started to see some evidence of a little bit of VIX backwardation, although it's not at levels that I think are probably important just yet. There's 70% of stocks now that are down more than 20% off their highs. So, any given year when the market's down 20%, the odds certainly are in your favor to try to take a stab at trying to buy for a rebound. But it's much, much different, in saying that is it a bottom versus the bottom, and whether it's going to be a recession with a capital R versus a small r. And really none of us know the question to that. But, I think it's a great risk reward when I start to see some evidence of equity put to call getting close to 1, which was near what we saw in March 2020. Obviously, some evidence this past week of a little bit of oversized selling, that meaning the TRIN or the ARMS index showed 2 readings of over 3.5. So some big selling on the downside. And that came specifically from a lot of groups that had not been going down recently, like energy all of a sudden and utilities. And, these starting to join technology on the downside, I think is a meaningful change in character for this market that investors should pay attention to.
When do you make a more definitive statement, and what causes you to do so? What's the level that makes sense to you in your mind?
Well, look, technical analysis is all about price action. And while, myself or anybody could say we're getting close, we need to see markets go from a downtrend to starting to make higher highs and higher lows. And unfortunately, there's no way to catch the bottom of that. That's going to take a movement over 4,200. So I have some cycles that suggest that we're going to bottom towards the end of June, towards the Russell rebalance, potentially as early as next week. And I think a couple things are important. One is that we seem to be getting close to a time when yields and also the dollar should peak out. And those are important because times when the dollar is rising rapidly happened in 2000, 2001, 2008, also 2014. Those proved to be difficult for the market. So if growth starts to slow meaningfully, and we're seeing evidence of copper breaking down substantially this week in a way that the dollar starts to roll over, and I think that might be a few weeks away. And the 30-year has really peaked out right near 2018 highs. And we saw evidence today of technology outperforming as yields drop. So that's the key for investors. Watch when yields and the dollar start to roll over. Growth should start to act better. You look at FANG stocks this week, stocks like Apple, Amazon, Netflix, they were only down about 3 to 5%, much better than the overall average. So seeing that outperformance in some of these high growth technology and discretionary names should be very important to the indices. So, it's tough to say we're at the bottom. I still think we're probably going to 3,500 to 3,600 over the next couple of weeks. But I am much more willing to take a stand and say I'll buy here and think that indices are higher within 3 to 4 months.